Your assessment here, because the tone from Fed officials since we got that meeting has been more tilted to the hawkish side.
It has indeed, and you know, based upon your nice summary here, I think that these minutes reinforce that theme, that if the data plays out as the committee expects, then I think a hike at the December meeting is likely. As I looked at my Bloomberg screen coming down to the studio, it was about an 80% probability of a December hike going into these minutes, and I don't think that's going to change very much after that. You're right to acknowledge, and the Fed acknowledges, the hurricane data, hurricane impacts are going to impact the data, and if anything will add some noise to the calculation. And you're right, I think the committee does think that at least some of the decline in inflation is transitory, but I think longer term it's something they will be watching. But I think a December rate hike does look to be very much still in play here.
And I think it's critical that you say the inflation point is what they'll be watching. We spoke with Chicago Fed President Charlie Evans, and he talked about inflation earlier in the day.
Getting inflation up to 2% is something that's very important, and moving inflation expectations up by just talking about it, making sure we're willing to go above 2% if that, actually happens, because we've got a symmetric inflation objective. That's my opinion. We do have a symmetric inflation objective. I think we should be willing to push inflation above 2% because we should be spending some time above 2%, just like we've spent quite a lot of time below 2%.
He said we should be willing to let inflation go above 2%. Is he in the minority here, Rich Clarida?
Well, I'm not sure. I mean, actually, I applaud Charlie for saying that, because, the Fed has said that Chair Yellen has said 2% is not a ceiling. It should be something of an average. But since the Fed became an inflation targeter, inflation has been below 2%, I think, every month now for going on 6 years. And so I think Charlie Evans has a good point. In particular, I think if you want inflation expectations to be stable, which the Fed does, then it's going to have to spend at least some time above 2%. So I think that makes some sense, yeah.
Now, in terms of the data and how it's perhaps not being corrupted but influenced by the hurricane, how much does that really factor into what the Fed does, not in December, but the following year? Because the effect will be more than just 1 month, 2 months.
That's a good point, Scarlet. I think historically you tend to see sort of the big temporary swings tend to be within 2 or 3 quarters after the tragic events. At that point, you then start to see any residual effects from rebuilding, which obviously can be positive. You've had obviously destruction of housing, destruction of infrastructure, so that's a negative. But there will be some follow on. I think the main distortions, however, are usually within the first 2 or 3 quarters of the event.